Hey, welcome everybody to class. First of all, apologies. This took so long. Usually I do these classes on Monday, but tonight we are on Thursday. I'm still catching up. It's been a crazy week, guys, but I apologize. But hey, I still got it to you this week, and I'll have everything ready for you next week as well. So nobody's missing a class. You just had to wait a little longer. Anyways, let's get right to it tonight. I had somebody ask, would you talk about dividend stocks and
Thursday.
long-term
I'm
investments? And
still
I thought that was
catching up.
actually a great idea. I know I kind of touched upon it before for just a little bit, but and I've accumulated a great deal of knowledge. The problem is I just haven't had the funds to also do the long-term investing. However, if you're young and you do this now, you'll be very well taken care of later. But the good news is also if you're older and you've already built up something, you can start doing this to actually increase whatever you want, whether you're planning to retire or you just want to be an investor the rest of your life and live well off it. These are the ways that are safer and more assured to really grow your wealth long term, and it gives you the opportunity to be diversified in multiple areas, getting a little bit here, a little bit there. But what it does is that it puts your money to work nonstop. Now, it's one thing like, in our the community I have on YouTube and Twitter, a lot of that is going after the stock market, making quick gains and hoping for short squeezes, all that. And the reason for that is a lot of people just are trying to play catch up from years and years and years of not knowing what to do. um, it's been the economy, whatever. All we're told is get a job and maybe match your 401k. But the problem with that is that, and I'm going to show you guys some more of this tonight. 401ks are managed by other people, and the fees can be exorbitant. Not only if you withdraw early, those fees are killer, but if over time the fees really add up, they really take away from what you're putting into it. Now, some of that is offset by, say, like an employer match, but at the same time, it's a pain in the butt if you change jobs and you switch back and forth. The truth is that if everybody really knew what they were doing, we'd all manage our own money and we'd all be making a lot more. And so that's the point of this class, is to get that in to our heads, so that when you do come into money, or if you're young enough to really start, even at a small level, investing in these things, you're going to find out the keys to building long-term wealth. And we're going to go through a couple calculators on that and everything as well. So, but first of all, I just want to talk a little bit about what are dividend stocks. So, a stock is a pretty simple thing. You buy, well, it used to be a piece of paper, but now it's digital. But you're buying a piece of a company. And so if the stock market, it wasn't basically a casino these days and so crazy, what it should be is you buy a part of a company, you hold that part of a company, and as the company grows, more people invest and it gets bigger, and that price goes up and you get paid back for your investment. And that's wonderful. That's how it should be. I wish it was that way. Unfortunately, it's not. And when the economy goes bad, stocks go down, but over time it should raise. And in fact, since the last 85 years, the average return on the S&P 500 is 10%, which is huge. That means the S&P 500 as an index fund has gone up 10% on average year after year for 80 years. That's a crazy fact. And the truth is that you can't depend on that. 80 years is actually very recent history. It's not long term, but it's still, I mean, if you were in the last 80 years, that's great. Unfortunately, there always could come a time like in Japan where, they hit a high in the 90s with their stock market, and they just re-hit that high again the other day. It took them 30 years to get back up there after a crash. So that can happen in regular stocks, and that's why regular stocks, they can be really good especially if you believe in the company, but it's not always the kind of thing you want to hold on to for life, unless you just really find the right thing. But the beautiful thing about dividend stocks is that you're not just dependent on the price with these stocks. They're paying you for holding. And that way, no matter what, you're still making money as long as that company is in business. And as long as their stock is listed and qualifies for these dividends, which most dividend stocks are actually very good companies. ExxonMobil for one. I mean, where are they going to go anytime soon? So you buy into these really secure long-term companies that probably aren't going to go anywhere for another 100 years, and they start paying you. So companies, their shares in companies that pay regular cash dividends to shareholders. These payments come from the company's profits, typically distributed quarterly. So there you go. Once every quarter you get paid. Various types of dividend stocks, including regular dividends, which is paid consistently over time, and special dividends, one-time payments. Special dividends, as some of you might know, are sometimes like an influx of new shares. Like maybe you get 10% new shares. Maybe you get warrants so you can exercise for shares later. And every once in a while, it's a cash dividend. The company might have had a great quarter, great year. And so as a reward, they give everybody, I don't know, $1 per share you own. If it's a $50 stock, or a quarter per share. And if you own 100,000 shares, well, for a quarter a share, they give you 25 grand. And I mean, that does happen. It's crazy. And it's probably usually not that much either, but it does happen. So the benefit is income generation. You get a steady stream of income, and it's definitely useful for retirees or those seeking passive income. Now, I'll say something else on this, is that it also, right here, compounding returns, if you reinvest those dividends, it can significantly boost the overall return on your investment. And then stability in volatile markets. Company that pay dividends often have stable earnings, can be less volatile, which I already talked about. But let's go back to the compounding returns. So it might seem nice to have a bunch of dividend stocks and live off that income. That sounds great, right? I mean, who wouldn't want to do that? You just chill. But to actually make that worth your while, you're going to want to already be probably a multimillionaire, or have at least several $100,000 put away that's earning for you in other ways. But if you're not, then this is what I recommend you do. So there's something called, I'm going to skip ahead here and then I'm going to go back. There's something called DRIP. And DRIP is a dividend reinvestment plan. It allows you to automatically reinvest your dividends to purchase additional shares, enhancing compounding effect. It is better than a 401k. And let me show you how this works. So we're going to go to this calculator over here. And we're going to pick a stock. And now I put Exxon in this earlier. So I'm going to put Exxon in this again. And actually, let's do a portfolio. And then we'll go back. So you see DRIP right here. This is set to on. Okay. Now, what are we starting with? I decided we're going to start with 100,000. Actually, no. Let's start with 10,000. All right, because I want to show what the long-term effects is for somebody who might not have a lot already. And you decide to contribute. Let's just make this 6,000. So that's $50 a month. No, is that correct? No, that's not correct. $500 a month. Sorry, guys, my brain. $500 a month, which, if you're making a decent salary, you can do that. You can put $500 a month to your plan here. And we'll say the dividend tax rate, this is just kind of what it's set at. We'll leave it alone. In America, your tax rate is going to depend on your income level. All right. And so your capital gains could be as low as 0, and it could be as high as 20. We'll just say it's at 15 here. And then initial average dividend yield, we'll say 3.39%. That's, I believe, what Exxon was at. And we'll leave this the same as well. And now let's say your portfolio just grows at 5% a year. All right, so less than the S&P. We're being very conservative here, all right, because being very conservative is a good thing. And let's say you're only going to do it for 20 years. All right, so you have 6,000 starting at 10. Adding 6,000 a year for 20 years, so that will end up being 120,000 you add. So you're putting 120,000 in, and you're not taking anything from your dividend, your DRIP. It's just staying in there. Okay. So sorry about the dogs. All right, let's calculate what that comes to. And there you go. You end up with 286,936. You made almost 300,000 off your $130,000 investment. And that's with the drip on, because it keeps buying and buying and buying. All right. So it doesn't seem like that much, but you didn't put that much in. You didn't put that much in. All right. And it's only been 20 years. But watch the difference when you turn the drip off. You just lost 60 grand. 60 grand. So that's why I recommend leaving drip on. Let's leave that on. Now, let's change this over here. All right, because compound interest means the longer you leave it in. So let's just go up to 25 years. We'll leave everything else the same. 5% again. I'm being very S&P averaged 10%, so I'm being very conservative. At 25 years, look, that extra 5 years netted you an extra $140,000. And this is only with putting in $6,000 a year. But let's say you want to bump it up. Okay, say you're 30 years old and you found a way to put in $1,000 a month. All right. Yeah. No, I'm sorry. Let's do this instead. We're going to leave it at $6,000, which is $500 a month, because you're 30 years old. You got kids. You got a wife. That's hard. Even that $500 a month is a strain. Okay, so this is, say, like 7% of your income. Say your income is 75 grand a year. That's about 7%. We'll leave that there. But this is what we're going to increase, because you're 30 years old. And you're not, you're looking at 60 as retirement. So you go up here and you put that up, and now you're up to 613,000. Now you just put in 7% of your income a year. You didn't change. We're being conservative here. And you already got over $500,000. Doesn't seem like much with inflation, but when you consider the fact you didn't put that much into it overall, not a bad return. But let's do this. Let's say you actually were able to get 6%. Adds a whole 100,000 over those 30 years. And let's say over time you bump this up. So you actually, when all was said and done, you averaged 7,500 a year, because you're doing better later in life. You're adding more to this. Well, now you're at 865,000. And this is all because you're in dividend stocks and you just got a good portfolio going. You're playing it safe. But watch what happens when you take the drip off. You just lost $200,000. All right. So it really makes a huge difference, which is why I recommend doing it. And would you have gotten 200,000 back? Like, would you be living off 200,000? No. Now, let's say you're really ready to do this and you actually are able to put more in. Go away, fly. Let's say you start with 100 grand. 1.7 million. Do you see the huge difference about where you started? So remember, before we start conservative, and now we're going back to like somebody who really has stuff in there ready to go. What's up, Calvin? How you doing, man? Any questions you got, bud? Put them in the chat. Let's turn the drip off on this one. You lost 600 grand right there because you didn't just let the dividends Now, there's no problem with this if you can afford it. If you can afford not to have it, keep investing. So now let's say you're older. Okay, you're older and you just want to do this for the next few years. So say you're 55, but you've already got some savings. So we're going to start out with 300,000 here. But your annual contributions also can be much higher. Let's say, you're just really putting into it. So, but you don't have as much time. So what I say, 55. So let's say you're going to do this for just 10 years. In 10 years, okay, You almost doubled your money. Okay, but that's with the drip off. So this whole time you've also been earning money on your dividends. All right. In fact, your average dividend, 17,000. So you could just be using that money to supplement your income. But if you drip it, 895,000, and that's just in 10 years. But let's say you really want to, you have money. You're okay. You're ready to just put that money in. You got 2 million. And let's say you're not even looking to put anything in anymore. All right, you turn the drip off. You're not even putting anything in here. You just want to get dividends. Well, with 2 million in dividend stocks, that pays 82,000 a year. You can live on that. So, it works. It's and then you're just staying in. It's at this low entry. I mean, again, this is expecting a rather conservative return on your share price appreciation. So, I mean, if we went to 7%, your dividend doesn't change much, but your ending balance sure does. So this is without you pulling any money out. So this is going up while you're also making 82,000 a year, but that's starting with 2 million. All right. So what if we started? I got somebody asking 100,000 over 10 years. We're turning drip on. And is there an annual contribution? What are you putting in yearly? That's important. So let me know. Let me know what you plan to put in yearly, and then I'll put it on. And we'll move this back down to 6 just to be conservative. All right. Did you have something you wanted to put in yearly? No annual. Okay. No annual. You're not going to make much. Your annual dividend would be $5,000. I mean, you're still making $5,000 a year, and your stocks are going up over 10 years. You double. Okay. You start with $100,000 over 10 years. Your end balance $225,000, but you're making $5,000 a year just on dividends. Oh, I'm sorry. That's drip on. My bad. Turn drip off. Sorry. That's end balance $179,000, and your annual dividend income is about $4,100, and that's because the drip isn't continually buying you new shares, so it goes down a little bit. All right. So you get a little bit of extra money, but you see the value in putting the drip on, and that's only because you only invested $100,000. So you're not making a ton of money on dividend stocks until you really have that money in there. You understand? It takes time, but there are some stocks that pay out a little higher. So over here, I just pulled up. This is Forbes best dividend stocks right now. All right, and this is as of right now, July 2024. So this one, CubeSmart, is paying 5% right now. 5-year average annualized dividend growth, they're going up 10% a year, which is huge. That means every year they're adding 10% to this right now. We'll see how long that lasts. ADP growing 12% over a year. That right now their dividend yield is 2.3%. Caterpillar 1.5%. So honestly, some of these dividends aren't as high right now, but their growth is, that's why they have them here. You see the growth is 10% a year. They're expecting that. This one's 16% year over year. They're going to keep growing United Health. That's pretty huge. 14% on Broadcom, Caterpillar 9%. So these are planning on growing every year and increasing that dividend. Now we can go over here, back to our dividend calculator, and we can put in, let's see what Caterpillar comes up on here. All right, so Caterpillar, like Exxon was 3.5%. That's pretty huge. Caterpillar 1.5%, but their annual dividend increase, according to Forbes, where was Caterpillar? 8.6%. Oops. That's a 6.6. We're going to move that up to 8.6. The share price, though, is huge. $330. So let's say at $300, man, you're looking at even 10 grand's only going to buy you 30 shares. So we'll do 100 grand. So you have 300 shares. And over 20 years, with no drip, your ending balance is $1 million, but your annual dividend income is 50 grand. That's with no drip. Let's add the drip. And you go out, you shoot up. And your average in dividend income by the end is 67,000. So, you see the drip is what makes the dividend stocks extremely valuable over time. Unless you have a crap ton of money, you don't make much on the dividends. Now, if you're in a short squeeze and you make a ton of money, let's go back down to a portfolio. All right, we're going to start with a portfolio here, and we're going to have multiple dividend stocks. We're going to bump this up to 2.5 because it's how it goes. And I'm just going to, I made my money. I'm happy. Let's say I have $5 million. And I'm not even going to contribute annually anymore because why? I'm doing well. I'm going to turn off the drip. And I'm just, I'm going to stay invested. Because just why would I pull my money out if I can live off the dividends? And you just see it's your annual dividend income is going to be $1.5 million by the time things are said and done. But if you even did it for just 5 years, you're living well. Even probably the very first year, you're living at about 175 a year. Let's see what it says. Okay, 140 would be your first year of dividend income. That's just stupid. That's just stupid. And that's only growing at 3% a year. Okay, this is going to go up. So you see, once you have money, you can just invest in dividend stocks and you're fine. You don't even have to work anymore. Just put it in dividend stocks and sit back. But that's not what most people want to do. Most people want to. And by the way, I know somebody who does this. Okay, I know somebody who does this. They made... I'm trying to think about what their worth was. I think they made about $25 million. And let's see, they've been invested for about 20 years. And everything else looks about right. Yeah. They just chill now. He does do other investments, but he's just chilling for the most part. That's his dividend income off 25 million. He's making 3.3 million a year right now off his dividends. So that's how dividend stocks work, people. That's how it works. So if you're looking at dividend stocks as an investment, you want to have that drip on because dividend stocks are a great way to safely build money. If you have a ton of money, dividend stocks become an excellent way to get yourself paid yearly and also have your money in fairly safe stocks. So this is how Warren Buffett lives, man. He's got, I don't even know what his rate is, but he never has to pull his money out. He only pulls it out when he knows he's going to lose some. But if you just add, this is 25 million. So you go 250 million, and then we'll add one more just to make it 2.5 billion. And your boy Warren Buffett's living off 331 million or so more a year because he's worth more than 2.5 billion. So, Fidelity has drip. Every single broker has drip. if you're investing in dividend stocks. So you can set it up and really make something of it. I mean, it's stupid. It's stupid what's available to you in dividend stocks if you do it right. you know, so and I recommend it over. Well, I'm not recommending anything. I'm not a financial advisor, but personally, I'm looking to this over 401ks, and the reason why is because 401k fees are crazy. I don't want to pay somebody else to manage my stuff. I don't want to have to pay the fees when I get out. This way, I'm in full control. And the fact is, people just don't know much about this thing. So, if just an example here, this is what happens with the fees. And an average 401k fee is about 1%, but some of them are 1.5%, 2%. So let's assume a 35-year-old worker leaves 20 grand in his 401k plan when he switches jobs, never adds the account. If the account earns 7% a year minus 0.5 in fees, balance would grow to about 132 at retirement. That's just that 20% sitting there at 7% a year for 30 years. That 20 grand turns into 132. All right, with 0.5%. But the fees are 1.5%. The 20 grand only grows to 100,000. So he just lost about 25% of that 401k value because of an extra 1% fee. Over 30 years, the additional charges, whittled it down by nearly 25%. So 401k fees, I mean, it's a nice, easy way if you don't know what you're doing. You can still make money off 401k. Obviously, if you want to play it super safe, but that's not why you're in this class, right? You want to learn how to control your money. So, all right, let's go back here. All right, so when evaluating dividend stocks, you want to consider the dividend yield, which is the annual payment divided by the stock price, shows how much income you get for each dollar invested. Payout ratio, percentage of earnings paid out as dividends. Lower payout ratio suggests company retains enough earnings to invest in growth. Dividend growth rate, I'm like freaking Elmer Fudd here. Annualized percentage rate of growth of the dividend over a period of time. Companies with a history of increasing dividends are preferable. And again, I showed you over here, they had an annualized growth plan, and there's their dividend yield. So that's what you're considering, all those factors in it. Okay. And this is the hot ones right now in July. There's obviously more. Exxon is one of the most famous. There's plenty of dividend stocks out there. So do your own research, find what companies you like the best. And my thing is, I would be finding what you feel like is going to be around the longest and has a great ability to keep paying for a long time. So financial health of the company obviously matters. But like oil stocks are really good for this because oil's not going anywhere. So Exxon, Caterpillar's great, obviously, because construction, stuff like that. I probably wouldn't get into a shiny new stock with the dividend if it's a company I don't know much about or they don't have a huge track record. Focus on companies' history of consistently increasing dividends, indicating strong and growing earnings. High yield dividend investing. Target stocks with higher yields for immediate income. Be cautious of very high yields, indicate financial distress. Reinvestment strategies is DRIP, which I went over. Okay, let's look at a few others. We're going to go look at a couple other safe options and a couple which is a good place to put money if you just want to preserve it, and a couple riskier options to, it's good to diversify. So I would say, like, if you're in the place where you're really ready to long-term invest, you're going to want to have like 10% of your portfolio in very, very safe things, bonds, precious metals, stuff like that. And then you're going to want to have, 25%, maybe more. It all depends on what you want, honestly. And say dividend stocks, and then put a position, maybe start investing in some real estate or other businesses. We're going to go through all of it here, but the point is diversify from safe to risky, because the risky, if you have 10 to 20% in very safe stuff, you always have a fallback. If you have 10% of play money, so to speak, in risky investments, well, you feel great because you're so protected with everything else. And then you have stuff that you can actually take some flyers on and really try to make some money on, for your children in the long term, maybe for yourself if you have some really high financial goals, all that stuff. But you just allot a portion of it and you say, I'm going after this business or I'm going after this stock. And that's what you do with that money. And you just hope, yet out of the 10%, maybe 3% of it hits big, and then it makes up for the 7% you lost, something like that. You take big risks, but most people, they make a lot of money because they do two things. A, they invest wisely, but B, they protect what they already have. And that is important to protect, but you can't move forward if you protect everything. So bonds, we'll talk about bonds real quick. Government bonds issued by national governments generally considered very safe, U.S. Treasuries. And so right now, let's pull up the Treasury rates. So right now you have like the 10-year is at 4.2%. So if you buy right now and you hold it and cash out in 10 years, you make 4%. Not much, but it's the U.S. government. It's like, where's that money going? So you make 4% a year up to when you sell them at 10 years. And it's, that it's not a lot of money again, but if you think the stock market's going to crash, and you think it's going to take 10 years to even get back to where it is, or anything like that, or if you just want to put aside some money so it's accruing value, you're 5% or 10% and you're being very careful with, that's fine. You make 4% a year, and then at least when you get it back, hopefully it's worth more than inflation. That's kind of what you hope for with bonds. And so you can buy, but there's also, you can get 2-year bonds, you can get 30-year, they're all over the place. My grandpa loves bonds, man. He just loves bonds. There's corporate bonds, which, investing in companies, it's kind of like a stock, but a little more risk. And then municipal bonds, states, cities, local governments. It's like if your city wants to build a bridge, they might sell municipal bonds, and you're like, I trust my city. I'll buy some of those bonds. And so it's kind of how you work. They're essentially loans made to issuers agree to pay back the principal along with interest on a set schedule. Now it's like you're investing in your country almost, with a loan. Benefits and risk provide stability and predictable income, lower volatility compared to stocks. Interest rate changes can affect bond prices, risk of issuer default. So, and companies especially, obviously the USA, it's probably pretty low. Well, who knows now, but it gets riskier the smaller you get. Okay, so less risky, U.S. government. A little bit less risky, state government. A little bit risky after that, city. A little bit more risky after that, company, and so on and so forth. Index funds. Investment funds that aim to replicate performance of a specific index, such as S&P 500, comprise a diversified portfolio of stocks that match the index components. The S&P 500, on average, for 80 years, has performed at 10% a year on average. So some years a little low, some years might be negative, but then it might roar back the next year with 20%. So for 80 years, it's been 10% on average. So if you invested 40 years ago and you got 10% a year every year just by putting in an index fund, you're pretty happy with yourself. That's a great long-term investment, a wonderful long-term investment, actually. As I showed you on the calculator, it's like 5 to 7% is probably average for most stocks. So 10% is beating the market. You're basically betting on the U.S. economy. Now, you don't want to buy, nowadays you don't want to buy that on a high. But let's say that trend continues for another 80 years. Great. I don't personally think it will. I think that's a small, 80 years is basically a snapshot of history. But the point is, you can invest in these index funds. They're safer than regular stocks because it's betting on a large portion of companies. So you could buy the Dow, you could buy NASDAQ with QQQ, that's S&P, and there you go. It's comprised of a diversified portfolio of stocks that match the index components. So there you go. What are ETFs? Well, like Bitcoin just got an ETF. Exchange traded funds operate like index funds but trade on stock exchanges like individual stocks. Offer flexibility in trading, usually have lower expense ratios. So you can buy ETF of gold, you can buy ETF of oil, like all kinds of different things. And they trade like stocks, but they're based upon the value of whatever you're buying. So there you go. It's just like again a little safer, but I don't know. It's up to you. Do your research. Benefits: diversification spreads risk across many companies, reducing impact of poor performance by a single company. So if Apple tanks completely, or well, like today, Nvidia tanked bad. Well, a bunch of other stocks kept the index fund from collapsing. All right, but they did. It still was down overall in the day, but if Nvidia completely gets wiped out, there, you have all these other companies that if they're doing well, it could at least keep the index fund from collapsing. Low cost, typically lower management fees compared to actively managed funds, which managed funds, 401ks, mutual funds, stuff like that. And then passive management, designed to match performance of an index, providing steady and predictable returns over time. Again, the 10% over 80 years is an example. All right, building a long-term investment portfolio, you want to diversify. Spread across various asset classes. Already talked about that. Asset allocation. Determine the right mix on risk tolerance, investment horizon, financial goals. This is important. So you need to know your goals. Everybody's going to have different goals based on your time of life. Young people usually have higher goals. They're up for more risk. Older people who have money set aside already and assets, they're usually going to want to go lower risk. And good for you either way. You figure it out. But again, it's also up to your risk tolerance. So maybe you want to be rich, but you're even more scared of being poor. So you have low risk tolerance. Periodic review and rebalancing. In other words, just stay in your stuff. Don't just, don't just set it and forget it. I know that's a dream that everybody wants, but I don't recommend it. Always stay on top of your money. Like one of the best, when I was really struggling financially for years, I used to be afraid to look at my bank account. I really did. It was kind of like, if I don't look at it, I don't have to deal with it. But now it's the opposite. I check my stuff every day. I am on top of my money, and I'm not afraid. It's like you control your money or else your money controls you. So stay on top of it. Risk management considerations. Market risk. Understand market volatility is normal. Long-term investing helps smooth out short-term fluctuations. Inflation can erode purchasing power. Behavior risk, stay disciplined, avoid making investment decisions based on emotions or short-term market movements. In other words, don't do what I did, buying GameStop. Investing in businesses. Now, let's go to a couple other options. I put this in here for a reason. This is actually one of the best investments anybody can ever make, and very few people do it. It's one of the reasons small businesses are dying across America, because there's a lot of people in, say, small towns or communities that have great businesses, but they're retiring and nobody else is going to take on that business. And so that town ends up being left with only, say, Walmart or, Family Dollar or something like that. Meanwhile, if investors had been actually looking, they might have been able to get a lucrative local store or a local whatever. I have a friend who sells businesses. He has people come to him with their business. They're like, we're ready to sell, we're retiring, we're whatever. And what he does is he goes and finds a buyer for them. And he does very well for himself. And people are very happy with him, because what it does is it pairs entrepreneurs and investors with people who want to sell. But we need more of that. We need more of that. And it can be very good for you. And the other thing you can do is, if you don't want to run a business the rest of your life, you can take it over, hand it over to somebody, have them manage it, build it back up, and then you can sell it for even more money. So buying and selling businesses actually can be very lucrative for people. Unlike stocks, this involves directly owning part of the business or entire business, which is true. Types of business: buying existing businesses, many businesses for sale each year, ranging from small, local to large enterprises. Starting a new business, creating a new business from scratch based on market opportunities, personal expertise. One thing we're seeing right now in the AI boom, lots of people starting their AI businesses. Why? Most of them know they're not going to be around. Now they're selling it so they can hopefully get a little piece of the pie going really well, and then they can sell. They can sell at a huge valuation and make a bunch of money. And that a lot of people start businesses just to sell them. And then franchising, which a little bit less, but that's kind of if you really want to be into building a business and making the money that way versus selling it or investing your money more as an investment. This is more of like you're buying your job kind of thing. Benefits, potential for high returns, control over business ops, and personal fulfillment. Let's say for me, it's like a dream of mine to someday own a restaurant. I would just love to do that. So that's the personal fulfillment part. Risk, high initial capital requirement, operational risk, market competition, need for business acumen. Yeah, don't do it if you don't have business experience or at least have been trained up under somebody. You can find them all over the place. Is that? I had other stuff on here. I guess my all right. Well, I'm gonna end then with I don't know what happened to my notes, but the other, there's two others I didn't really go over, but it's because they're pretty simple, and it's precious metals, gold, silver, platinum. Those can be great investments, not for high returns usually, but for store of wealth. I mean, the truth is that long term, you can trust that they will at least probably beat inflation, and as they get rarer, can become more valuable. I mean, the way I look at it, if it's been money since the dawn of time, it's still going to be money at the end of time. And that's so I always think it's probably a good idea to put some money in precious metals. And then the other one is real estate. Real estate is just extremely valuable. Even if you lose money on it, or if you're underwater, it's still valuable because you own something. You can build on it. You can come up with something else. You turn it into a parking lot. I don't know. You can hunt on it. You can fish on it. You can cut down lumber on it. Whatever it is, it's like having tangible things are very valuable. They just are. And sometimes that value is more than money. But it's putting your money into something that is an asset. And over time, property is going to always appreciate. Sometimes that time stretches out pretty long, especially after like a market crash, but it will stretch out. And so real estate, always a great investment, especially if you can find good deals. So I guess I shouldn't say always a great investment. Sometimes you can overpay, especially if you say want to go buy a house in Malibu right now. You're probably overpaying. It's not a good investment, but you know what I mean. And then the last thing is crypto, which crypto is going to deserve its own segment. So I'm not going to go too far into that right now, but I will tell you this. A lot of people say crypto is a store of wealth. I disagree with that. The reason I disagree is because it's just too volatile right now. And we don't know. Okay, I'll be down in a minute. We don't know the future of crypto. And because we don't know the future and it doesn't have a huge track record, I'm very loath to call it a store of value right now. So I consider crypto an investment. I consider it a lucrative one, possibly lucrative, I should say. One I'm excited to get into. But it's also one that, because it's new, fresh, it deserves its own segment. So I will teach on crypto here another time. All right, guys. Well, that's going to do it for today's class. I hope this was helpful to you. I hope you guys learned. If you have any questions, please put them in the Patreon. Hit me up on Discord. I am happy to answer your questions. And if I don't have an answer for you, I'll go find one for you. All right. Anyways, God bless.